Okay, let's unpack something that might sound a little loud at first, but trust me, it's got the potential to send ripples through, your financial world. You sent us some fascinating, if a bit alarming material about, well, unexpected turbulence in what many consider the safest place, US Treasuries. We're talking about April 8th and 9th of this year, 2025. A couple of days that saw some truly head-spinning volatility.
Absolutely. Yeah, the materials you provided give us a really insightful look into this world of U.S. Treasury basis trade hedge funds and, of course, the market event itself. So our goal in this deep dive really is to cut through the complexities, try and understand what exactly happened during those dramatic days, why it matters, even if you don't trade bonds yourself, and what the potential aftershocks could be. We want to make sense of this without getting lost in the Wall Street weeds.
Right. Exactly. So at the heart of this seems to be this kind of mysterious sounding thing called the basis trade.
Yeah, for those of us who aren't constantly glued to the bond market, how would you explain what this is in, plain English?
No, sure. So imagine trying to profit from the absolute tiniest differences in the price of a US Treasury bond today versus the price of a contract that predicts what that bond will be worth in the future. That future contract is it's a futures contract. These price differences are often microscopic, like fractions of a penny sometimes. So to make any real money, these traders have to borrow a massive amount. We're talking about leverage of 50 times, 100 times their initial investment, sometimes even more.
Yeah.
Like betting in the house, the car, and, pretty much everything else you own on whether two almost identical things will eventually cost exactly the same.
Okay, that kind of leverage.
Yeah.
Yeah, that definitely amplifies things. So walk us through what actually happened on April 8th and 9th. What caused this tremor in such a seemingly stable market? Well, we witnessed a very rapid and pretty significant jump in Treasury yields. Think of the yield as the return you get on a bond, right? On Monday, April 8th, the yield on the benchmark 10-year Treasury note, it just shot up by a substantial 19 basis points.
19 points in a day. That's big for Treasuries, isn't it?
It really is. To put that in perspective for you, that was the biggest single-day increase we'd seen since, I think, September of 2022. Reports at the time had it hitting as high as 4.18%, and some even said 4.26%. It was moving fast. Then the following day, Tuesday, April 9th, the selling pressure, it just intensified. The 10-year yield climbed even further. It actually broke above 4.5% at one point during the day before, settling somewhere between 4.39% and 4.46%.
And it wasn't just the 10-year that was moving, right? It sounded like the longer-term bonds were experiencing even more dramatic shifts.
Exactly. The longer end of the yield curve saw even more pronounced moves. Really quite something. For example, the 30-year Treasury yield jumped by 21 basis points on April 8th. That was its largest daily move since the market chaos of March 2020. And on April 9th, it surged above 5% during the day. Some reports suggested it briefly touched 5.0% even before settling back around 4.84%. This kind of volatility in the 30-year yield, well, it had some seasoned market observers talking about the heaviest sell-off in that part of the market since way back in 1981.
1981, wow. That's a serious benchmark. And it sounds like market participants were drawing parallels to some pretty significant historical events, the global financial crisis, the March 2020 pandemic shock. Must have felt like some seriously Wild West trading conditions out there.
Oh, absolutely. People were using terms like wildest trading swings for 10-year yields in 2 decades. It was definitely shaking things up.
So what was the spark? What ignited this whole thing? What caused such a violent reaction in the market?
The primary catalyst seems to have been the announcement of aggressive new U.S. tariffs, targeting a wide array of trading partners. This news immediately injected just a huge dose of uncertainty. Uncertainty about global trade, about future interest rate expectations. It essentially triggered a broad sell-off in assets that are perceived as, carrying more risk.
So a classic risk-off reaction then. People getting spooked and selling risky stuff.
Initially, yes. That's what you expect. When the news first broke, there was actually an initial rush into the perceived safety of U.S. Treasuries for a moment, but that quickly reversed. Very quickly. Investors then started selling treasuries right alongside other riskier assets.
Selling treasuries with the risky assets. That's unusual.
It is. And there was also speculation swirling around, could major foreign holders of U.S. debt, maybe China, retaliate against these scares by offloading some of their treasury holdings? And to add to the mix, the market was already anticipating a significant amount of new treasury bonds coming to market through scheduled government options, a lot of supply. So it was really a confluence of factors creating this sort of perfect storm of uncertainty.
Okay, so we have trade war jitters, the potential for big players like China to sell, maybe, and a glut of new supply on the horizon. You mentioned that initial flight to safety in treasuries reversing. That's a really interesting point. It almost suggests that the long-held belief in U.S. treasuries as the ultimate safe haven might be weakening a bit.
That's precisely the concern that some analysts started to voice, yeah. The fact that treasuries ended up being sold off in tandem with everything else, it did raise questions. Is that traditional dynamic shifting?
Yeah.
Some commentators described it as an everything everywhere all at once type of market move. Or just sell everything, where funds across different sectors were engaging in broad deleveraging, just trying to raise cash. And when you need cash in a hurry, the most liquid assets, which unfortunately includes treasuries, they're often the first to be sold, even if it means taking a less than ideal price.
Right, easy to sell, even if it's maybe not the best financial decision in the long run if you hold on. Okay, so let's go back to that basis trade we were talking about earlier. How did all this market turbulence specifically impact those highly leveraged bets?
Right. Well, the sudden and sharp increase in treasury yields combined with the heightened market volatility, it really delivered a shock to the basis trade, a big one. Remember, these trades are based on those razor-thin price differences, right? And the enormous leverage involved magnifies even tiny adverse price movements hugely. So as treasury yields surged, the value of the long treasury bond positions held by these funds, well, it would have decreased significantly. And that decrease would have been massively amplified by their high leverage, 50 times, 100 times the loss. The increased volatility in the market likely also triggered margin calls on their futures positions.
Margin calls?
Yeah.
That's the broker demanding more money, right?
Exactly. It's your broker basically saying, hey, the value of your bet has dropped quite a bit. You need to put up more cash right now to cover potential losses. Plus, the cost of financing these trades in the repo market, that's where they borrow cash using their bonds as collateral, that might have gone up. Or maybe the availability of that short-term funding just got tighter, more restricted.
So it was a perfect storm for these guys. Rising losses, demands for more cash, potentially higher borrowing costs, all hitting these highly leveraged players at once. And the result of all that was this forced deleveraging that you mentioned. They just had to sell.
Exactly. To meet those margin calls and, frankly, to just reduce their overall exposure to risk, these funds had to rapidly unwind their leveraged positions. Sell, sell, sell. The primary way to do that in a basis trade is to sell the physical treasury bonds they held and at the same time sell their treasury futures contracts. Unwind both sides. And we saw clear evidence of this forced selling in a couple of key market indicators. Things that basis traders watch really closely. The spread, or the difference between the yield on the 10-year treasury note and the rate on interest rate swaps, a very closely related financial instrument. It widened out to a record 64 basis points.
64 points. That sounds like a huge move for a spread like that.
It's significant, yeah. It indicates real stress in the relationship between these two markets. Similarly, the gap between 30-year swap rates and 30-year treasury yields, it experienced its largest single-day move in years. It actually hit a record low. So market analysts looked at these widening and narrowing spreads and said, yep, that's strong evidence. A large-scale unwinding of basis trades is definitely underway, particularly at the longer end of the yield curve.
That makes sense. And we're talking about a substantial amount of money tied up in these basis trades, right? This isn't some tiny niche corner of the market we're discussing.
That's absolutely right. Not niche at all. Estimates prior to this event pegged the total size of the US Treasury basis trades somewhere in the range of $800 billion to $1 trillion, maybe even more.
$1 trillion.
Yeah. To put that in perspective for you, that's roughly the size of the entire economy of a country like, say, Switzerland. It really underscores the potential for a significant impact if things go wrong. Federal Reserve staff had noted an increase of at least $317 billion in basis trade activity by hedge funds since just the first quarter of 2022, so it had been growing rapidly. And data from the Office of Financial Research, the OFR, showed that hedge fund borrowing in the repo market had nearly doubled between December 2020 and December 2024. And a significant chunk of that increase is believed to be funding these kinds of highly leveraged basis trades. What's also a potential source of, systemic risk is that this activity appears to be quite concentrated. Some analysts suggest that the majority of these trades might be held by fewer than 10 large hedge funds.
Fewer than 10 funds controlling maybe $1 trillion in this highly leveraged trade. That sounds like a potential pressure point for the entire financial system. So these funds are facing losses, getting margin calls, being forced to sell off huge amounts of assets. It sounds like a really damaging feedback loop.
That's a very apt description, a feedback loop. The initial shock of the tariff news caused Treasury yields to spike.
Right.
That spike then triggered margin calls for these highly leveraged basis trades. To meet those calls and reduce their risks, the funds were forced to sell their Treasury bonds and futures contracts, which in turn put even more downward pressure on Treasury prices and pushed yields even higher, probably faster than the initial tariff news alone might have justified. This created a self-reinforcing cycle, rising yields, leading to more margin calls, causing further forced selling, which pushes yields higher again, amplifying the initial market shock. And reports did indeed indicate significant losses for relative value in macro hedge funds, ones that heavily used this strategy. And there was also evidence of broader deleveraging happening in other types of funds too, like long-short equity funds, as they also looked to just reduce risk across the board.
And it wasn't just the funds themselves reacting in isolation, was it? It sounds like the prime brokers, the big banks who lend money and provide services to hedge funds, they also played a pretty big role in maybe exacerbating the situation.
Absolutely. Prime brokers. They were critical in amplifying this deleveraging process. You can't really understand it without looking at their role. As the market became increasingly volatile and the value of the collateral they held, those Treasury bonds, declined sharply, prime brokers reportedly issued very significant margin calls to their hedge fund clients. Some individuals within the market characterized these calls as the largest they had witnessed since, the pandemic kicked off in early 2020. The rapid fall in Treasury prices directly reduced the value of the assets backing these repo loans. That led the prime brokers to demand more cash or additional securities to maintain the required margin levels. They needed to protect themselves.
So the banks were essentially saying to the hedge funds, look, your collateral is worth less now. You need to put up more money immediately, protecting their own balance sheets.
Exactly. And it wasn't just about the existing positions either. There were also reports that prime brokers started to tighten their overall financing conditions, just generally pulling back. This meant either increasing the margin requirements for both new and existing leverage trades, or in some cases, even reducing the amount of leverage they were willing to offer to their hedge fund clients altogether. As Mukesh Dave from Aravali Asset Management aptly put it, when prime brokers start tightening the screws in terms of asking for more margin or saying that I can't lend you more money, then these guys obviously will have to sell. These actions by the prime brokers really compelled the hedge funds to liquidate their assets very quickly. Sell now, ask questions later maybe, just to meet these newer, more stringent demands and reduce their overall leverage. This forced selling, of course, added further downward pressure on Treasury prices and potentially triggered even more margin calls in a cascading effect. There were even reports circulating of emergency meetings being held among prime brokerage teams on Wall Street as they tried to figure out what was going on and manage their own risks.
Wow. It really paints a picture of a system under, immense pressure. And you touched on this a bit earlier, but it seems like there might have been some deeper, more fundamental vulnerabilities present in the Treasury market itself, things that contributed to this particularly sharp and unsettling reaction.
That's a very important point, yes. While the tariff announcement acted as the initial spark, the sheer intensity of the market's reaction, it does suggest that there were likely some underlying fragilities already present. Maybe the market was brittle. Factors such as the persistent and growing U.S. fiscal deficits, the historically high levels of outstanding government debt, also, the elevated levels of geopolitical tensions around the world and even potential limitations in the ability of the primary dealers. Those are the large banks that act as intermediaries in the Treasury market, limitations in their ability to effectively absorb very large and rapid trading flows. All of these could have contributed to an environment where the market was just more susceptible to such a sharp and disorderly dislocation. The fact that even U.S. Treasuries, traditionally seen as the safest of safe havens, came under significant selling pressure after an initial brief flight to safety, well, it does lend some credence to the idea that their unquestioned status might be eroding somewhat. That could potentially lower the threshold for significant sell-offs when unexpected shocks occur in the future.
Okay, so this forced deleveraging we've been discussing wasn't just contained to those basis trade hedge funds, was it? It sounds like it had much broader implications for the entire financial market ecosystem. It started to spread.
That's a crucial point to understand, absolutely. The deleveraging by these hedge funds didn't happen in a vacuum. It wasn't isolated. The stress rapidly spread from the core US Treasury market to other closely related fixed income segments. And that raised broader concerns about the overall level of market liquidity and the potential for, systemic risk, the risk that the failure of one part of the financial system could trigger a wider collapse. Participants in the Treasury market itself described a real destruction of liquidity during those 2 days, April 8th and 9th. Now, we might not have precise real-time data on things like the bid-ask spreads for those specific moments, but the sheer magnitude and speed of the yield movements, they strongly suggest a very significant deterioration in the ease with which these usually highly liquid securities could be traded.
So it just became much harder to buy or sell without moving the price dramatically?
Exactly, which is particularly concerning because the US Treasury market is typically one of the most liquid and efficient markets in the world. The situation even drew comparisons, as we mentioned, to the severe illiquidity that was seen during the height of the market panic in March 2020.
And you mentioned that the capacity of those primary dealers, the big banks that are supposed to maintain liquidity in the Treasury market, that might have been a contributing factor to this drying up of liquidity.
Yes, there's a growing concern among market observers that the balance sheets of primary dealers might have become somewhat stretched in recent years. Maybe they don't have as much room to maneuver. This could be due to the consistently large volume of new Treasury bonds being issued by the U.S. government, funding the deficit, and also the Federal Reserve's program of quantitative tightening, or QT, where they've been actively reducing their own holdings of government bonds, adding to the supply the market needs to absorb. So when you have a situation of large and very one-sided selling pressure, like we saw, especially during periods of heightened volatility, these dealers might become less willing or less able to step in and absorb all of that selling inventory onto their own books. This can exacerbate price declines and lead to a further reduction in market depth, making it harder for anyone to buy or sell without significantly impacting prices. This potential limitation in the ability of primary dealers to effectively intermediate trades is a recognized vulnerability in the current structure of the U.S. Treasury market.
So, if the dealers can't always step in and absorb the selling, who does? And how does this lack of liquidity in the Treasury market then spill over into other parts of the financial system that you mentioned? Where else did we see problems?
Well, when liquidity dries up in the usually super liquid Treasury market, it creates this ripple effect throughout the financial system. It doesn't stay contained. We saw reports that this deterioration in liquidity extended to the high-grade corporate bond markets, investment-grade bonds. As hedge funds and other investors were scrambling to raise cash and reduce their overall leverage, they weren't just selling their Treasury holdings, they were also selling other relatively liquid assets in their portfolios, which would include these high-quality corporate bonds.
Selling the good stuff, too, just to get cash.
Right. This broad-based selling pressure then led to a widening of credit spreads. That's the difference in yield between corporate bonds and comparable U.S. Treasury bonds. This widening reflects an increase in risk aversion among investors and a decrease in the perceived liquidity of the corporate bond market itself. It's all interconnected. You have multi-asset funds liquidating across their portfolios and just a general increase in risk aversion prompting investors to reduce their exposure even in what are typically considered higher quality assets.
And it didn't just stop with corporate bonds, right? You also mentioned agency mortgage-backed securities earlier.
Exactly. The market for agency mortgage-backed securities, or MBS, those are the bundles of home loans guaranteed by government-sponsored entities like Fannie Mae and Freddie Mac. That market also experienced significant stress during this period. Participants in that market reported a similar destruction of liquidity. Same language being used. These securities are often held by many of the same types of investors who are active in the Treasury market, and they are typically considered quite liquid themselves. So they also became subject to significant selling pressure as investors looked to raise cash and deleverage across their fixed income portfolios. And the smooth functioning of the agency MBS market is really critical for the stability of the U.S. housing finance system. So disruptions there can have much wider economic implications for homeowners and the broader economy.
Okay, and what about the underlying plumbing of the financial system, the repo market, where institutions borrow and lend cash using securities as collateral? That was also affected, wasn't it? Sounds like it must have been.
Oh, yes. The repo market, which is absolutely vital for short-term funding within the financial system and is heavily utilized by those engaging in basis trades, it also experienced considerable stress. As Treasury prices fell rapidly, the value of those treasuries being used as collateral in repo transactions also declined, which likely triggered margin calls from the repo lenders, just like the margin calls we discussed earlier from the prime brokers in the futures market. More demands for cash. This forced borrowers, including those hedge funds involved in basis trades, to either put up more cash, post additional collateral, or just unwind their positions altogether, get out of the trade. Since basis trades involve simultaneous activities in the cash treasury market, the treasury futures market, and the repo market, any disruption or increased cost in the repo market can really amplify the initial shock. It just makes it more difficult and more expensive for leveraged players to finance their positions and maintain those trades. This intricate interconnectedness really highlights the potential for what we often refer to as liquidity spirals. Yeah, where a shock in one part of the financial system can quickly spread and intensify through these various interconnected channels, like a contagion.
It sounds like this wasn't just an isolated event confined to one corner of the market at all. It really had the potential to create much broader instability. And that brings us to the idea of systemic risk. What were financial analysts and, maybe more importantly, regulators saying about the potential for this to become a more widespread and serious problem? Were alarm bells ringing?
There were definitely significant concerns being raised about the potential for systemic risks to emerge from this episode. Yes, alarm bells were ringing, or at least being checked. Financial analysts and regulators have been warning for some time now, even before this, that a disorderly and rapid unwinding of these highly leveraged US Treasury basis trades could indeed pose a threat to broader financial stability. International financial bodies, the Bank of England, the European Central Bank, the Bank for International Settlements, the BIS, the IMF, they've all, in various reports and statements, highlighted the potential risks associated with the buildup of leveraged positions in government bond markets globally. And the U.S. Treasury basis trade has been specifically mentioned as a key concern. The Bank of England even went as far as to warn prior to this about the potential for these types of trades under certain adverse conditions to trigger a more widespread market meltdown.
Yeah.
Strong words.
Market meltdown. Wow.
Yeah. And here in the U.S., officials at the Federal Reserve have also publicly drawn attention to the increasing levels of leverage being employed by hedge funds, particularly in the U.S. Treasury market, as a key area of focus for financial stability monitoring. Torsten Slok, a well-regarded analyst at Apollo Global Management, he explicitly linked the sharp spike in Treasury yields we saw on April 8th directly to the unwinding of these basis trades, really underscoring the market's sensitivity to these dynamics.
And that concentration of risk that we talked about earlier, with potentially just a few large funds holding a significant portion of these trades, that seems like a major worry when we're talking about potential systemic issues, right? If one or two blow up.
Absolutely. That concentration is a huge factor. The fact that a relatively small number of large, highly leveraged hedge funds appear to dominate a significant portion of this basis trade activity. It means that if even a few of those major players were to run into serious financial difficulties simultaneously, it could have an outsized and very destabilizing impact on the entire market. It makes a rapid and disorderly liquidation of their positions much more likely than if these positions were more widely dispersed across a larger number of smaller participants. The Federal Reserve's own financial stability report has noted that the average gross leverage among hedge funds has reached historically high levels and is also highly concentrated. With the top 10 largest hedge funds accounting for a very significant portion of the total borrowing that occurs in the repo market, this concentration of both leverage and activity just amplifies the potential for contagion and systemic risk.
So how does this situation in April 2025 compare to what we saw back in March 2020, that infamous dash for cash at the start of the pandemic? Were the underlying issues in market dynamics similar, or were there key differences?
Yeah, March 2020 serves as a really important point of comparison for understanding what happened here in April 2025. It's the benchmark recent crisis. Research suggests that while the Treasury basis trade did indeed contribute to the significant market stress that we saw back in March 2020, it was initially more of a consequence of the much broader market panic and the urgent dash for cash caused by the sudden onset of the COVID-19 pandemic, rather than being the primary cause of the initial market turmoil. The whole world was selling everything then. The very swift and massive intervention by the Federal Reserve at that time, huge asset purchases, QE, setting up lending facilities that's widely credited with ultimately stabilizing the U.S. Treasury market, and preventing the disorderly unwinding of basis trades from causing even greater and more widespread damage back then. The Fed stepped in hard. However, a key difference, and frankly a source of concern now, is that the estimated size of the U.S. Treasury basis trade appears to have grown substantially since 2020. It seems significantly larger in 2025 compared to its estimated size back then, potentially in that $800 billion to $1 trillion range, or even more now, versus maybe around $500 billion back in 2020.
So almost double the size.
Potentially, yeah. Or at least significantly larger. This much larger size raises concerns that a similar rapid unwinding event now could play a more direct and potentially more significant role in driving market instability if it's not effectively managed. It might be the cause this time, not just a consequence.
That's worrying. But it sounds like financial regulators have been paying much closer attention to these kinds of risks in the government bond markets since that wake-up call in March 2020, right? They weren't completely sat-footed this time.
They definitely have been paying more attention, yes. Since the significant market disruptions we witnessed in March 2020, global financial regulators have significantly increased their focus on the potential risks coming from these types of highly leveraged trading strategies in government bond markets around the world. There have been numerous reports, speeches, statements issued by senior officials at the Fed, the Bank of England, the ECB, the IMF, other international bodies, all demonstrating a heightened level of awareness and concern. They're worried about the financial stability risks associated with the US Treasury basis trade and similar leverage strategies used by hedge funds and other non-bank financial institutions, or NBFIs. They clearly understand the potential for forced deleveraging in these trades to significantly amplify market shocks and disrupt the smooth functioning of critical financial markets like the US Treasury market. They know the playbook now, at least.
And were there any specific warnings or indicators from regulators in the lead up to this April 2025 event that might have foreshadowed this kind of volatility? Were they saying, hey, watch out for this?
Yes, there were definitely signals that regulators were monitoring these risks closely. It wasn't a complete surprise from their perspective, maybe. For instance, the Bank of England had noted in its financial stability report prior to April 2025 that while large hedge fund short positions in U.S. Treasury futures had decreased somewhat from their peak levels, they still remained at historically significant levels. So, still big positions out there. Both the Bank of England and the European Central Bank had explicitly linked the buildup of leveraged exposures in the U.S. Treasury market to potential financial stability concerns in their publications. They warned about the risk of disruptions in the repo markets, potentially forcing the unwinding of these leveraged positions, basically describing what happened. And here in the United States, officials at the Federal Reserve had also publicly pointed out the significant surge in hedge fund leverage to historically high levels. And importantly, the concentration of that leverage among a relatively small number of firms as areas that required close and ongoing monitoring. Even the International Monetary Fund, the IMF, had highlighted the potential for concentrated positioning by hedge funds to worsen market unwinding dynamics, particularly in situations where the ability of traditional market makers, the dealers, to step in intermediate trades is limited, maybe due to their own balance sheet constraints or other factors.
It sounds like the Bank of England actually provided some interesting insights right around the time of this April event itself, like on April 9th.
They did, yeah. Following the initial market jitters after the U.S. tariff announcement, the Bank of England's Financial Policy Committee issued an update on April 9th. Real-time commentary, almost. Based on their ongoing monitoring and market intelligence, they noted that while various funds had indeed faced significant margin calls in response to the increased market volatility, they had, so far, been able to meet these margin calls without resorting to actions that would further destabilize the broader market. That was their initial read.
Okay, so maybe not a full-blown crisis yet, according to them.
At that moment, yes. They also suggested that some hedge funds might have even proactively reduced their risk exposures somewhat in the period leading up to the tariff news. Maybe they saw it coming or just got nervous, and that could have potentially lessened the overall impact of the subsequent market moves, some de-risking beforehand. However, in the same update, the Bank of England also highlighted a very sharp and concerning increase in the use of leverage by hedge funds in the UK government bond market, known as gilts, specifically through borrowing in the repo market there. This leverage had reportedly jumped dramatically in a relatively short period and was concentrated in just a few funds. So it indicates that these trends increase leverage, potential concentration of risk, are not solely a U.S. phenomenon. It's happening elsewhere, too.
Right, and what about the Federal Reserve's perspective in all of this? They have a pretty broad mandate when it comes to maintaining financial stability and ensuring the smooth functioning of the crucial U.S. Treasury market. What's their angle?
Absolutely. The Federal Reserve's mandate, it extends beyond just inflation and jobs. It also includes a very important responsibility to foster overall financial stability within the U.S. financial system and also to help moderate long-term interest rates. They fully understand that a well-functioning and resilient U.S. Treasury market is absolutely critical for the effective transmission of their monetary policy decisions throughout the economy and just for the overall stability of the broader financial system. If the Treasury market breaks, everything breaks. Former senior officials at the Treasury Department, like Nellie Liang, have consistently emphasized the ongoing need for reforms and enhancements to ensure the long-term resilience of the Treasury market infrastructure. People know it needs work. The Federal Reserve actively monitors the activities and risk-taking of non-bank financial institutions like hedge funds through various means, including conducting stress tests that include scenarios involving shocks to NBFIs and even the failure of some hedge funds, as well as through the continuous collection and in-depth analysis of a wide range of market data. They're watching.
Okay, so when we compare April 2025 to March 2020, we see different initial triggers, tariffs versus pandemic, but some concerning similarities in the market reactions. Forced selling, liquidity drying up. And the basis trade seems to have been a significant factor in both episodes, maybe playing an even larger and more direct role this time around because it's bigger. The Fed's response in March 2020 was very forceful and swift. Huge intervention. What about their options now? What kind of tools do they have at their disposal to address this kind of situation, and what might their overall intervention outlook be in the current environment? Are they likely to step in again?
Right. The Fed does have several tools that they could potentially consider deploying if things get bad enough. There are the standing repo facilities, specifically the Standing Repo Facility SRF and the FEMA Repo Facility for foreign central banks. These were set up after March 2020. These facilities are designed to act as a liquidity backstop. They allow eligible financial institutions, mostly banks and primary dealers, to borrow cash from the Fed on an overnight basis using high-quality collateral like treasuries and agency debt. However, it's important to note that hedge funds generally do not have direct access to the SRF.
So the guys causing the problem can't use the fix directly.
Pretty much, yeah. So its immediate effectiveness in addressing a situation driven primarily by hedge fund deleveraging, like the one we saw in April 2025, is somewhat limited. It helps the banks, which might indirectly help, but it's not direct. There's been ongoing discussions and even formal proposals, like one from the Group of 30, G30, to potentially expand access to the SRF, expand it to a wider range of financial participants who actively trade in and can pledge US Treasuries as collateral, maybe including some NBFIs.
Okay. And there's also been some discussion about a potential new, more specifically targeted tool, something designed just for this kind of basis trade problem.
Yes, exactly. There has been a proposal put forward by a group of financial market experts for the creation of a dedicated emergency facility, specifically designed to address dislocations in the U.S. Treasury basis trade. This proposed basis purchase facility, as they call it, would ideally only be activated and utilized during periods of acute market stress, not an everyday tool. The core idea behind it is that the Federal Reserve would step in to purchase U.S. Treasury securities from distressed sellers potentially, including those hedge funds facing margin calls, while simultaneously selling offsetting amounts of U.S. Treasury futures contracts, buying the cash bonds, selling the futures. This hedged approach aims to directly facilitate the orderly unwinding of these basis trades without requiring the kind of large-scale, unhedged expansion of the Federal Reserve's balance sheet that typically occurs with quantitative easing programs.
So it's more surgical, less broad impact than QE.
That's the idea. Proponents argue that it's conceptually similar to the Fed's regular open market operations, just deployed in a targeted way during a crisis. However, there are also valid concerns. The big one is moral hazard.
The idea that if you know there's a safety net, you'll take more risks.
Precisely. The risk that market participants might be encouraged to take on excessive levels of risk if they believe that the Fed will always be there to step in and prevent significant losses if their bet goes bad. To mitigate this risk, various safeguards have been suggested, like using options to determine the purchase prices, maybe applying penalty discounts for those who use the facility and make it costly to use. But, the legal authority for the Fed to even implement such a facility and the practical details of how it would operate, those are still subjects of ongoing discussion and analysis. It's not ready to go tomorrow.
Gotcha. And then, of course, there's the big one. The most powerful, but also perhaps the most controversial tool in the Fed's arsenal, quantitative easing, or QE, buying massive amounts of bonds.
Right? QE. It involves those large-scale purchases of assets like US Treasury Bonds and agency mortgage-backed securities by the central bank. It is certainly the Federal Reserve's most potent tool for injecting liquidity into the financial system and for helping to stabilize market conditions. We saw it work, arguably, in March 2020 and after the GFC. However, it is also a very significant policy decision with potentially broad and long-lasting implications for the overall economy. It's a sledgehammer, not a scalpel. And given the Federal Reserve's current concerns about persistent inflation and their stated desire to continue the process of normalizing monetary policy, which includes reducing the size of their balance sheet through QT, they would likely be very reluctant to resort to another round of large-scale QE unless there was a truly severe and systemic breakdown in market functioning, something that posed a very significant threat to their core mandates of price stability and maximum employment. QE would likely be reserved for a situation that threatened a much broader financial crisis, not just a wobble in the basis trade.
So it sounds like the Fed might be leaning towards considering more targeted interventions if they feel compelled to act at all in this situation. Maybe the SRS expansion or this basis purchase facility idea.
That does appear to be the direction of thinking among many policymakers and market observers, yes. More targeted tools seem preferable, if possible. The ongoing debate between potentially expanding access to the existing standing repo facility and creating a new, more targeted basis purchase facility, it really highlights the search for intervention tools that are specifically designed to address the risks that can arise in the non-bank financial sector. Risks like the rapid unwinding of leveraged hedge fund positions, which we saw here, and doing it without having to resort to the much broader and potentially more distortionary tool of quantitative easing. The existing standing repo facilities, while helpful in providing general liquidity to the banking system, they're just not perfectly suited for directly addressing the kind of concentrated deleveraging we saw in April 2025. There's a real question of whether there is currently a gap in the crisis management toolkit for effectively managing leverage outside of the traditional banking system, and doing so in a way that minimizes unintended consequences and, importantly, that moral hazard problem.
Okay, so putting it all together then, what's your informed sense of how likely the Federal Reserve is to actually intervene in the near term? As of right now, following these April 8th and 9th events, what are the odds they step in?
Yeah, assessing the near-term likelihood of Fed intervention, it requires carefully weighing the severity of the market stress we've observed against the potential downsides and risks of intervening, and considering the tools they already have. On the one hand, the level of volatility we saw in the Treasury market on April 8th and 9th was indeed significant. As we said, GFC COVID levels were mentioned. And there have been some calls from market participants for a decisive response from the authorities. People get nervous and want the Fed to act. The apparent role of the basis trade unwind in amplifying this volatility, and the broader systemic risk concerns that have been raised. Those are certainly factors that could push the Fed towards some form of intervention. Plus, the precedent set by the Fed's swift and forceful actions in March 2020 creates a certain level of market expectation, right? That they will step in if conditions deteriorate significantly.
Right. People expect it now.
Exactly. Furthermore, the observed contagion from the Treasury market to other important fixed income markets like high-grade credit and agency MBS, that would likely be a cause for concern within the Fed, too. They don't want it spreading.
But there are also arguments against immediate intervention.
Right.
Reasons for them to hold back.
Yes, there are definitely factors that would likely make the Federal Reserve cautious about intervening too quickly or too aggressively. They don't want to jump the gun. The Bank of England's initial assessment on April 9th, which suggested that funds had generally been able to meet their margin calls so far. That might indicate that the situation, while stressed, wasn't yet spiraling completely out of control, maybe due to that preemptive de-risking we mentioned. The Fed is also likely to be very mindful of the risk of creating moral hazard if they're seen as always ready to bail out leveraged investors every time things get rough. They do have the standing repo facility in place, which provides a baseline level of liquidity to eligible institutions, even if not hedge funds directly. Some might also argue, maybe within the Fed, that the basis trade unwind in 2020 was more of a symptom of the broader market panic than a primary driver of systemic risk itself. Maybe it's manageable without intervention. And, of course, the big one. The Federal Reserve's ongoing battle against inflation would likely make them very hesitant to engage in anything resembling large-scale quantitative easing unless absolutely necessary to prevent a systemic collapse. QT is still the main policy direction.
So, okay, balancing all that.
Yeah.
What's your final take? Moderate chance, high chance, low chance of Fed action soon.
Given all of these competing factors, my assessment as of April 9th, 2025, is that there is a moderate to high likelihood of some form of Federal Reserve action aimed at stabilizing market functioning in the near term. This likelihood is certainly significantly higher than what we would typically expect to see in normal market conditions. The stress was real. However, it's really important to clarify. A direct bailout of specific hedge funds that may have incurred losses is still highly improbable. That's not the goal. Instead, any intervention would likely be focused on providing liquidity to the broader market and ensuring the smooth functioning of key segments like the Treasury and repo markets. System stability, not firm rescue. Potential initial actions could include maybe enhancing the existing overnight and term repo operations, just making more cash available through existing channels, or maybe issuing clear and reassuring communications from senior Fed officials to try and calm market anxieties. Jawboning, essentially.
Talking the market down.
Right. Or perhaps providing clearer signals about how the standing repo facility could be utilized by eligible participants within its current rules, just reminding people it's there. It's also quite possible that the Fed would be actively engaged in contingency planning behind the scenes. Planning for more targeted measures, like that proposed basis purchase facility, should the market stress persist or worsen, have it ready just in case. As we discussed, a return to large-scale QE would likely be reserved for a much more severe and systemic breakdown in financial markets. That's the last resort. The critical aspects to watch will be the timing of any potential intervention and how the Fed communicates its actions to the market. They'll need to carefully balance the need for effective stabilization with the imperative of avoiding moral hazard and encouraging responsible risk-taking in the future. It's a tricky balancing act. The Fed will definitely be closely monitoring those key market indicators we've discussed, Treasury yields and their volatility, measures of Treasury market liquidity, those basis and swap spreads, repo market rates, and financing conditions. Also, any further actions taken by prime brokers, the performance and flows of hedge funds, and, of course, any official communications or policy actions announced by regulatory authorities here or abroad. They'll be watching everything.
Okay, so just to quickly recap then, we saw a sharp and sudden sell-off in the U.S. Treasury market on April 8th and 9th. It appears to have been initially triggered by concerns over new tariffs, and then significantly amplified by the forced unwinding of highly leveraged basis trades by hedge funds, with the actions of their prime brokers playing a crucial role in tightening financial conditions and pushing things along.
That's correct. That sums it up well. We've seen clear signs of highly stressed liquidity conditions for those hedge funds engaged in basis trades, as well as a broader impairment of liquidity in the core U.S. Treasury market and related fixed income sectors, including high-grade corporate bonds and agency mortgage-backed securities. The stress spread.
And our assessment is that the likelihood of the Federal Reserve stepping in with some form of market stability measures in the near term seems quite elevated, moderate to high, you said. Although any such intervention would likely be focused on the overall functioning of the market, keeping the plumbing working, rather than on rescuing individual firms.
Precisely, market functioning, not bailouts. And it will be crucial now to keep a close watch on those key market indicators that we outlined. Treasury yields and volatility, market liquidity metrics, basis and swap spreads, repo market activity, prime broker behavior, hedge fund performance, and any official announcements from regulators. Those will tell us if the stress is easing or getting worse.
It's a stark reminder, isn't it, of just how delicate even the core of our global financial markets, U.S. Treasuries, can be when you have these complex, highly leveraged trading strategies interacting with unexpected policy shocks, like throwing a wrench in the works. And it really underscores the ongoing and, frankly, evolving challenge for financial regulators in trying to effectively monitor and manage potential risks that exist outside of the traditional, heavily regulated banking system. These non-banks are huge now. It really makes you think about that fundamental balance, doesn't it, between allowing for market discipline, letting people fail, and the necessary role of central bank intervention when things in these critical markets start to go sideways. Where do you draw the line? Thanks so much for navigating us through this deep dive. It's certainly given us a lot to think about and watch for in the coming days and weeks.
You're welcome. Definitely a situation worth watching closely.